Hello, everybody, and welcome to an episode of Tax Stuff You Should Know, a biweekly podcast that two partners from Eric Fox Schiff, myself, Bob Pluth, and my esteemed colleague, Evgeny Magidenko, hope to bring to you every 2 weeks on topics of interest that are useful and understandable. So, with that in mind, Gene, how are you doing today?
I'm doing pretty well, Bob. Cannot complain. Still enjoying those sunny Michigan days, for sure. Not that our weather is that different, but, I hear Chicago's not too bad now either.
Chicago is great. This time of year, it's the absolute best time to be in Chicago. So good to know, Gene. So let's get right into it. Today's topic is to talk about the assignment of income doctrine. It's a common law doctrine in the tax law that we bump into with more and more frequency, particularly in the gift tax area. But let me just set the table here. Gene, how would you describe this judicial doctrine, the assignment of income doctrine, and what is it that the IRS is trying to avoid in connection with it?
Sure, Bob. I think fundamentally, as you said, it's a largely judicially created doctrine spanning, many decisions over the past few decades, and fundamentally, it seeks to include an income, of a taxpayer, certain items that the taxpayer may be trying to exclude from income. Typically, where you see it is where you have someone who is perhaps anticipating receiving an income item of some sort, and they're trying to get rid of it by giving it to somebody else before actually receiving that particular item of income. Typically, I think we see it coming up where there's an assignment of income from services provided by a particular taxpayer or income from property. Perhaps there's an expectation that there will be a sale of an interest in a company that somebody owns, or perhaps someone is a service partner in a partnership and they're trying to get rid of that income by giving it to somebody else. Those are probably the most common situations, but certainly not the only ones where this is an issue, and where it's good to have some sensitivity, I feel, to assignment of income problems. As you mentioned, charitable contributions are a huge area where this can certainly be a problem to contend with. Another area is qualified small business stock. Section 1202 for those who are trying to keep score of code section references, and I'm sure Bob is shaking his head at my reference to a code section, but I couldn't let the episode go by without at least one.
The running gag here, of course, is we're trying to do this in a way that we don't use any code sections, but sometimes, Gene, it's unavoidable. So under the assignment of income doctrine, I can no longer have my partnership draw sent to my child's bank account and have them pay tax at a lower rate. Is that basically the long and short of it?
That's exactly right. Or, you may have someone who is looking to prevent a large gain from hitting their tax return, and they're saying, let me create some sort of a foundation, or provide a gift to a DAF or something along those lines to prevent recognizing that income and send it to a charitable foundation or a charitable organization that is tax exempt and won't have to pay tax on that. In the qualified small business stock world, where this comes up is you've got a $10 million exclusion for gain. And, if you have a very successful business and you have a liquidity event coming up imminently, perhaps you're looking at spreading the proceeds of that perhaps among different taxpayers. And so part of this is, kind of an ounce of prevention is worth a pound of cure, where if someone gave a lot of thought to this well in advance, perhaps you don't really run into assignment of income problems. But sometimes the liquidity event or an item of income comes up pretty unexpectedly, and some people try to get rid of it some way. And as the court cases have shown, occasionally that's successful and occasionally not.
Okay, terrific. You used the term DAF earlier. DAF is a donor advised fund.
That's right.
And just for our listeners, briefly, the reason why one might use a donor advised fund is if you're looking to make a large charitable contribution, but you haven't quite settled on the charity or charities that are the ultimate beneficiaries of that contribution. You can use a donor advised fund, which allows you to, as donor, make suggestions to the fund as to how you would like the funds to be deployed and which charities you believe are worthy of ultimate receipt of the proceeds. And so we see that a lot in our practice. We raise it for today's purposes because it plays in prominently into a relatively recent tax court case that we want to have a little bit of a discussion about. So to set the table on this, one of the ways that we see this doctrine coming up with more frequency these days is in the charitable contribution area. And the typical facts would be entrepreneur, small business owner, builds a successful business and gets to a point where he or she is starting to think about, gee, this has been a wonderful blessing to be able to have this business. I think I'd like to share my good fortune with charity and make a gift of some of my shares or LLC interests, because someday I may be looking to sell the business, become liquid, and turn those shares into cash. And as Gene pointed out, this is an area where if there is such a charitable intent, and if there is a potential for a liquidity event, sale of the business, then that charitable contribution is best done sooner rather than later, putting as much practical distance between the contribution and a potential sale as one might be able to, so as to avoid any implication that the reason for having made the contribution was to avoid the portion of the gain on the sale that's attributable to the shares or the member interest that the charity holds. Is that kind of a fair way to set the table there, Gene?
I think so, Bob. I think so. And really where this does come up, I think it's, equally charitable and, equally just in the gift context. Because if you have a taxable disposition of the interest, it really doesn't pose an issue unless it's, for less than fair market value, or maybe you have a bargain sale, part gift, part sale type of situation. But fundamentally, I think it boils down to that. That's exactly right.
Okay. And in a charitable contribution sense, we've certainly seen the IRS being interested in making sure that the driver for the contribution is really charitable as opposed to tax planning. There's certainly nothing wrong or nefarious with tax planning, as we know, but in this particular space, being able to show that the donor had a bona fide charitable intent is always a plus to avoid any sort of question about whether or not assignment of income should be applied. As is implicit, I guess, in this is charities, of course, if they own shares of stock or LLC member interests, typically don't pay tax when those interests are sold. They don't pay tax on capital gains. Now, there are exceptions to the rule. You could have unrelated business taxable income in the context of a LLC member interest, for example, that is financed in part, the business is financed in part by debt. There are some special exceptions, right, Gene, to the unrelated business taxable income rules.
That's right.
But let's put those aside for the moment. So the plain vanilla way that these things can come up is business owner decides to transfer some closely held stock to, and let's just say for these purposes, a donor advised fund, because he or she isn't entirely clear on who the ultimate charitable beneficiaries might be. And it also turns out that business owner knows that there's some interest out there in purchasing the business. One of the things that we want to do is to show, as I mentioned earlier, that we've got all the elements of a valid gift, being donative intent to make a gift and to put those funds in the hands of the charity and beyond the reach of the donor, an actual or constructive delivery of the shares or the business interests involved. Although with LLCs, oftentimes those member interests are not certificated. There aren't certificates as you would have with a share of stock. So it may be a little more subtle in terms of manifesting the delivery, and then actually have a physical acceptance by the donee. And so those are the key steps. And then the question can arise if it turns out that that gift is made, let's say, today. And by the way, we are broadcasting today. We're not sure exactly when you're going to hear this, but it's Monday, September 16th. So let's say today on the 16th, we've got a donor that does exactly that, transfers some shares. And let's say that, come a month from now, it turns out that the donor ends up selling the business. That's really the issue that we wanted to sort of highlight today, because it may be the case that friendly IRS revenue agent, in looking at a tax return for the year of the contribution, says, this is interesting. I see that the date of the gift was the 16th. I see that the date of the sale was, let's say, October 16th. And now I'm interested to know, as of September 16th, how likely was it that a sale was in the works, or there were negotiations, or any interest shown by a potential buyer. And understand that these kinds of transactions will be looked at with the benefit of hindsight, so that from the face of the taxpayer's tax return, his or her 1040, there will likely be a Schedule D showing gain from the sale of the remaining shares, not the shares not given away, or member interest not given away. There will also be some significant paperwork, right, Gene, on the charitable contribution?
Absolutely, yeah. There are some boxes that need to be checked, some administrative requirements to confirm that a charitable contribution was done correctly. So, if obviously if you have a cash donation of a certain amount, there's typically a requirement that the charity issue a receipt for that. If it's again in excess of a certain number. If you donate goods in kind, then again, there's a documentation requirement if that exceeds a certain amount. And, and if you're donating shares of stock, and typically we're talking about more than, a few dollars worth of shares, if assignment of income really becomes a salient issue. And so in those cases, you're looking at a number of requirements, including a qualified appraisal, a Form 283 that you would need to include with the return. You also perhaps would need a donor acknowledgement, and and certainly the donee, if they end up reselling the shares down the road, then they would need to perhaps document that as well.
We should probably add that qualified appraisal is really a term of art in this area. There are some very specific requirements that the appraisal needs to touch upon, not the least of which is a recitation saying that the appraisal is being given for income tax purposes. So the appraiser understands the context of the engagement and what the appraisal is going to be used for. Likewise, the appraiser is going to have to sign that Form 8283 as a further acknowledgement of the valuation. In this case, the valuation of the shares at issue. So all well and good, and that's a whole separate potential conversation, because there are a variety of hoops to jump through, as Gene had mentioned, and a variety of ways that one might fall short of the various requirements that the IRS demands. Let's assume, for the sake of this discussion, that everything is in order. We've got a good appraisal. We've got a good Form 8283 that gets attached to the return of the taxpayer, and if the gift is large enough, the contribution is large enough, the appraisal actually has to be attached to the return, or at least an appraisal summary. So there's absolutely no question, if someone at the IRS is looking at this, that they'll be able to see sort of a sequencing here, that there happens to be a contribution in a year where there also happens to be a sale. And one of the things that we're seeing is, given the IRS's current campaign to audit high net worth individuals, and high net worth individuals tend to make significant charitable contributions, God bless them. There is more audit activity around this very issue and around these very facts. And with that in mind, there's this tax court case. It's called the Estate of Hoensheid, Hoensheid versus Commissioner, that was decided in 2023, that deals with this very fact pattern, as I mentioned. Gene, do you want to give us a little color around the case to help bring it to life a little more for our listeners?
Of course, and this case actually comes from my home state, so there's a bit of a local connection as well. At its core, this case involved a contribution of appreciated shares of stock in a closely held family corporation to a charitable organization that administered donor-advised funds, or DAF, staffs. The contribution, though, was made almost contemporaneously with the sale of those shares to a third party, and that's really where the taxpayers ran into some problems. Though there were some other potential issues there that the court went through that did not necessarily inure to the taxpayers' favor in this particular circumstance. So the court zeroed in on four primary problems that they needed to get through. And unfortunately, the taxpayers, I'm not going to bury the lead here. The taxpayers did not prevail in this particular case. The first issue that the court focused on was whether and when the petitioners made a valid contribution of stock. As Bob mentioned a couple minutes ago, there are certain elements of a valid gift. And this is largely driven by state law about when do you have a valid gift and what are those components. But by and large, they're pretty much the same across the board, consisting of three things: donative intent being the first, the second being some form of delivery of the subject matter of the gift, whether it's actual or constructive, and finally, acceptance by the donee as the third criterion for having that valid gift. And in this case, the gift was valid, but it was later than the taxpayers thought or later than the taxpayers asserted. And this is part of what did trip them up. The second issue that the court focused on was whether the petitioners had unreported capital gain income due to their right to proceeds from the sale of those shares, and whether that right became fixed before the gift or afterward. This is where the timing of the gift was very important, because if the gift was made before the right to income from those shares became fixed, then the taxpayers would have probably been in a pretty good position. Unfortunately, because of some defects with the gift and some delays related to the delivery and acceptance of the gift in this case, again, the gift occurred a little later than the taxpayers anticipated. The third issue that the court looked at was whether the petitioners were entitled to a charitable contribution deduction. To some degree, this does tie back into whether the gift was made and when was the gift made. And finally, whether the taxpayers were liable for accuracy-related penalties under the code. And on this one point, I think the taxpayers did encounter perhaps a little bit of silver lining. But that aside, it was not necessarily the most taxpayer favorable case, and perhaps a situation where, as we like to say, bad facts make bad law.
And the court used, as I recall, Gene, as sort of its test, is whether the sale was practically certain to occur, right, at the time the contribution was made. And so if the answer to that is yes, the sale was practically certain to occur, and the contribution is made at that point in time and not beforehand, that's going to be a case that the taxpayer is not successful with. But if the taxpayer can show that's not the case, that, for example, significant negotiations were continuing, price was not agreed to. In essence, they didn't have a deal. It turns out that they struck a deal maybe a month or two later, but there was no deal at the time of the contribution. Those are facts that's the area the taxpayer wants to be in. As I said at the outset, better yet, the taxpayer would like to be in a position to say, look, I gave the shares away last year, and it just so happens that this year somebody came along and made me an offer I couldn't refuse to buy my business. But that's not, it's not necessarily always the case. So, in that regard, one of the things that we look to as practitioners, when there is a situation that is arguably a close call, or one where you say, gee, it would have been helpful had the contribution been made earlier, is to make a record, make a file, if you will, of where the negotiations are, what the state of those negotiations were at the time the contribution was made. And if, as I mentioned, there are significant contingencies to close, and those could be not only the parties still really haven't agreed on fundamental terms, but it could also be that there's a significant financing contingency where the buyer says, gee, I really want to buy your business, but I don't have the money. I've got to go down to my friendly banker and see if a loan can be made, and that loan isn't made for weeks or months later, even if maybe the general contours of the deal are struck. That's a very good fact from the taxpayer's point of view, because there is no sale practically certain to occur if there's no wherewithal in the buyer's side to actually pay the purchase price. And so trying to marshal those facts and have them in the file, if you will, contemporaneously with the deal is, number one, it's more probative to do that in real time. Number two, it's a lot easier to do than maybe to reconstruct it 2 years later when you find yourself in the midst of an audit. Now, there are other circumstances, though, Gene, where the situation isn't the entire business is being sold, but sometimes what we'll see is a redemption transaction. Can you speak to that a bit and some of the differences in the analysis?
Certainly, and what it really boils down to is the factual analysis, Bob. And I think you delved into this with some great examples about cases where you really have to look at the facts to evaluate whether you did cross that line. Situations where the sale had become practically certain to occur by the time of the gift. And this is notwithstanding, any remote or hypothetical possibility that the sale will not go through, because it's oftentimes easy to point to some nominal contingencies that, while on their face appear to be, something that you need to contend with. But if those contingencies are not likely to happen, perhaps there's some sort of financing contingency. On the one hand, if it's a protracted struggle to get financing, that's one thing. On the other hand, if it's just a pro forma contingency and you have the sources of funding already lined up, those are two very different situations that can result in different conclusions on otherwise pretty comparable facts. Mm-hmm. In the Hoensheid case, the court did spend a lot of time looking at the relevant documents. There were a bunch of emails that they had to look at as well in making this determination, and ultimately the taxpayers did not prevail in that case because the gift just happened too close in time to the sale, in part because of defects in the gift itself, but in general, this is something that, where you have someone looking at making a gift so closely to an anticipated sale, then, you do run into potential issues with this. Now, compare that to another situation, like you said, Bob, of a redemption, where perhaps a gift would not have been made. So comparing that with something like a redemption or a similar transaction, and this is something that was looked at to some degree in the Hoensheid case to differentiate Hoensheid from another case from a couple years before, which was the Dickinson v. Commissioner decision that was released by the tax court in 2020, that on some kind of facial circumstances was similar to Hoensheid, but with some key differences. That particular case involved contributions to Fidelity of shares in a privately held corporation that had been held by the CFO. And those contributions by the CFO were then followed shortly by redemptions of the shares that were contributed to Fidelity by the corporation. In this case, the court held that the form was to be respected. And the reason being was that the redemption was not a foregone conclusion at the time of the gift. And therefore, the taxpayer did not avoid receiving the redemption proceeds by contributing the shares. So in other words, in almost a polar opposite of Hoensheid, in the Dickinson case, the redemptions would not have occurred but for the charitable contributions. So if no charitable contribution had occurred, then there would have been no redemption, there would have been no sale of the shares. And by that logic, there almost by definition could be no practically certain to occur realization event to avoid at the time that the gift happened. And the Dickinson case relied on an older tax court case, the Hoensheid Company case from 1964. And in that particular case, that was kind of conceded to by the IRS in a subsequent revenue ruling. The IRS had argued against this, but the court held in favor of the taxpayer, where you have a donation followed by a sale. It is respected if the donor gives property away absolutely in parts with title to that property, and this occurs before the property gives rise to income by way of a sale. So in the Dickinson case, the redemption only occurred because of the gift. In the Hoensheid case, the sale was happening regardless of whether the gift would have occurred or not. And because of that key difference, in Dickinson, the taxpayer prevailed. In Hoensheid, the result was considerably less favorable to the taxpayer.
And the revenue ruling that you had mentioned that plays into the redemption is interesting, I find, because it involved a situation, as I recall, where the taxpayer who made the contribution of shares that were ultimately redeemed actually had voting control over the corporation. So if the taxpayer wanted to, he or she could have caused the corporation to do a redemption transaction. But again, that was separate and apart from the charitable contribution of the redemption.
And that was notwithstanding that there was a prearranged plan. So that revenue ruling said, even if you have a prearranged plan to do the redemption, as long as the charitable organization is not legally bound to redeem, and in point of fact, it's typically not, it could refuse to have those shares redeemed, though I think in practice most charities would elect the redemption option because they don't want to hold interests in a closely held corporation. But in the absence of compulsion like that, then the IRS would respect that as a valid gift, and then a separate redemption transaction that would not appear on the donors on the taxpayer's tax return.
Mm-hmm. Good point. You had mentioned that the court in Hoensheid talks in some great detail about the detail in various emails and correspondence that it had before it. Interesting, because the court in some instances was going day by day, sometimes hour by hour, through that progression of the various correspondence with the charity, with the buyer, with the taxpayer's own counsel. And the court was, as a result, able to reach a conclusion that they felt the deal was really essentially done prior to the contribution. One thing to just remind us all of is it appears from the facts of the case that the attorney that represented the taxpayer in connection with both the sale of the company and the contribution was also his tax preparer, as I recall. And as a result, I'm only surmising this, I have no reason to know one way or the other, but surmising that the attorney-client privilege wasn't available in a robust way in this particular case. The service and the case law, by the way, for many years takes the view that if you confide in your lawyer, who is your tax preparer, facts that your lawyer needs to put into the right form on your tax return, there is no privilege for that because you fully intend to disclose, frankly, are required, let's say, to disclose that information to the IRS, on your Form 1040. And it's kind of a good reminder to be mindful of privilege in situations like this. And probably a good reason to not have the same folks doing your return as perhaps are advising on the substantive transactions. Any other thoughts on that, Gene?
I think that's a very good point, Bob. And one thing that sometimes comes up is in the course of a transaction, you have a transaction team and There's the client, the lawyers, and potentially other advisors on email chains. The presence of those other advisors may pose a problem, especially if those other advisors are not acting in a legal capacity. Maybe you have financial advisors on email chains as well. That can be enough to break open the attorney-client privilege with respect to the matters discussed on those emails. So that's something to be very mindful of as well. Likewise, if a client forwards an email that a lawyer sent to non-attorney advisors, that could also be problematic if it's going to someone other than perhaps some other attorneys with whom the taxpayer also has attorney-client privilege, because that can break open that privilege in that type of a situation as well.
Yeah, terrific points. We have seen in our practice audits of these kinds of transactions. The IRS is well aware of the Hoensheid case, and the revenue agents are asking, questions, very detailed questions, following sort of Hoensheid as a script. They're very anxious to see drafts of the transaction documents, to see, who was saying what to whom when, and very much drilling down into the minutia of transactions, if they believe that they are coming at a time period that's too close, whatever that might mean in the eyes of the service, too close in time to the time of the prior contribution. So just something to think about. The other thing that was interesting in our practice is we've seen there seems to be basically kind of a coordinated national campaign as well, specifically on in-kind contributions to donor-advised funds of closely held business interests. And so folks that are doing those kinds of transactions, which are completely and perfectly legitimate, should be aware, nonetheless, that they may well be called to sort of defend the bona fides of their contribution down the road. And as I said earlier, if you're doing that 2 or 3 years after the actual transaction, takes place, memories can get a little fuzzy, and at a minimum, it becomes a bit of a project to try to reconstruct the timeline, if you will, back at the time the transaction was being negotiated. Any other takeaways, Gene, in light of all this?
No, I think a key one is contemporaneous documentation is very important. The probative value of something that's documented at the time the transaction occurs is far greater than something that's pieced together potentially years later from disparate sources and well after the fact. So I think that's a key point. Another one is just plan ahead. You don't want to be making charitable gifts within a few weeks, if you can avoid it, of a potential transaction. The more distance you can put between them, generally speaking, the better. It's not an end-all and be-all, to be sure, because in some cases, it's really the particular facts that you'd have to look at. So if you're just dragging out closing, but all contingencies are done, it doesn't matter if there are a few months in the interim. You probably wouldn't win on an assignment of income challenge. But if perhaps you think maybe you're going to be selling a company next year, then doing charitable planning this year may be a great idea. Yeah. Again, it's important to put some time there and really make sure that just because there's a possibility of selling it, that's not enough to get you into assignment of income problems. It's once you've taken steps to sell something and then you try to make a gift, that's really where people end up getting into some problems.
Good advice. Good advice, Gene. And as always in the tax law, the ultimate test is trying to get to the substance of the transaction, not the form. And we see in these cases, as we would expect, both the service and the tax court really drilling down to try to get a better understanding of what was going on at certain points in time in relation to the contribution, and that's sort of taxes 101 in many respects. So I think with that, that's a wrap for today. We really appreciate you tuning in. We look forward to being with you on our next podcast. In the meantime, take care. Gene, you too, huh?
You too, Bob.
All right. Bye-bye.